You've probably heard it 100 times. VOO averages 10% a year. Just buy it, hold it, and let it grow. It's the biggest ETF on the planet. Over $900 billion in assets, more money than any single fund in history. And honestly, that advice works if you're 35 years old and still adding money every paycheck. But something changes the day you retire. The day you stop putting money in and start taking money out. That's when VOO's famous 10% average stops telling the whole story. Because there's a gap between the number Wall Street talks about and the number that actually shows up in your retirement account. That gap has a name, it has a formula, and if you don't understand it before you start withdrawing, it can quietly drain a portfolio, even one that averaged 10% the whole time. And the worst part? The people this hurts the most are the ones who did everything right for 30 years. Today, I'm going to show you exactly why retirees lose money in VOO even when the returns look great on paper. And then I'm going to show you a simple 3-bucket fix that solves it. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always talk to a qualified professional. Let's get into it. The number Wall Street doesn't explain. When someone says VOO averages 10%, they're using something called the arithmetic mean. You add up every year's return and divide by the number of years. Simple math, easy to quote, and technically correct. But here's the problem. Your money doesn't grow by averages. It compounds. And compounding follows a different number, the geometric mean. There's actually a formula for the gap between them. Geometric return equals the arithmetic return minus half the variance. The more your returns bounce around from year to year, the bigger that gap gets. For the S&P 500 going back to 1928, the arithmetic average is 11.7%, but the actual compounded return, the number your account statement shows, is 9.8%. That's nearly a 2-point haircut. Experts call it volatility drag, and it's not an opinion, it's math. Let me make it real. Say a fund goes up 30%, then down 20%, then up 30%, down 20%, up 30%, down 20%. 6 years. The average return? Positive 5% per year. Sounds pretty good, but run the actual dollars. You start with $100,000. After year 1, you're at $130,000. Then you lose 20%, down to $104,000. Up 30%, $135,200. Down 20%, $108,160. Up 30%, $140,608. Down 20%, $112,486. 6 years of a 5% average gave you $12,486. That's 1.98% per year, not 5%. The average overstated your real return by more than 2.5 times, and that's without withdrawing a single dollar. So if the average lies when you're just sitting there, what happens when you start pulling money out? The retirement math that breaks everything. Let me introduce you to two people, Richard and Evelyn. Both retired on the same day. Both had $1 million in VOO. Both pulled out $50,000 a year adjusted for inflation. And here's the key. They earned the exact same average annual return. But Richard got hit with a bear market in his first 3 years. Evelyn got those same bad years at the end. Richard ran out of money. Evelyn ended retirement with over $800,000. Think about that. Richard did everything right. He saved for decades. He picked the most popular fund in the world. He followed the 4% rule, and he still went broke. Not because of bad decisions, because of bad timing. Same average, same withdrawal, same fund. A difference of over $740,000, caused entirely by the order the returns showed up in. This is called sequence of returns risk. Bill Bengen, the man who invented the 4% rule back in 1994, was the first to put math on this. When you sell shares during a downturn to pay your bills, those shares are gone. They don't come back when the market recovers. You sold them at a discount, and every share you sold low is one less share compounding for you later. And this isn't just theory. Let me show you real history. From January 2000 to December 2009, America's lost decade, the Vanguard 500 Index Fund had a positive arithmetic average annual return, positive 1.12% per year. But if you put $10,000 in on January 1st, 2000, you had $9,012 by the end of 2009. 10 years, a positive average, and you still lost money. Now imagine you retired that same year with $1 million in that same fund. You start pulling out 4% adjusted for inflation. By the end of 2009, your portfolio was down to roughly $455,000. A diversified retiree pulling the same amount ended the decade near $1.2 million. Same decade, same withdrawal amount, a $745,000 gap. That's the power of sequence risk, and VOO has zero built-in protection against it. But the crash isn't even the biggest problem VOO has for retirees today. There's a quieter issue, and it's the reason retirees are being forced to sell shares they shouldn't be selling.
VOO pays you 1%. Here's a number that surprises almost everyone. VOO's dividend yield right now is about 1.05%. That's the lowest it's been since the dot-com bubble in the year 2000. On a $1 million VOO position, that's roughly $10,500 a year in dividends. If you need $40,000 or $50,000 a year to live on, where does the rest come from? You sell shares. And selling shares in a down market is exactly how sequence of returns risk destroys portfolios. The fund that built your wealth doesn't generate enough income to live on, so you're forced to cannibalize it. Why is the yield so low? Because roughly 35% of VOO is just 7 companies, the Magnificent 7. NVIDIA yields 0.02%. Alphabet pays 0.29%. These mega-cap tech stocks pull the entire index yield down to levels not seen since 1999. And it gets worse. About 41% of VOO sits in just 10 companies. Goldman Sachs now projects only 3% annualized returns for the S&P 500 over the next decade. That's the 7th percentile going back to 1930. For a retiree, VOO right now is a low-income, top-heavy tech bet disguised as diversification. Here's the myth. VOO is diversified across 500 companies. Here's the truth. 41% of your money sits in 10 stocks, and the dividend yield is the lowest in 25 years. Before I show you the fix, drop a comment right now. Is VOO your biggest holding in retirement, or are you using something different? I read every single comment, and I want to know what your setup looks like. Now, here's the 3-bucket fix, and it doesn't mean selling VOO. It means changing how you use it. The VOO fix. 3 buckets. You don't sell VOO, you fix how you use it. The answer is a 3-bucket system. It was created by a financial planner named Harold Evansky, and it's taught today by Christine Benz at Morningstar, one of the most respected voices in retirement planning. Here's how it works. Bucket 1 is your cash bucket. This holds 1 to 2 years of living expenses. You put it in something safe, a treasury bill ETF like SGOV, which pays about 3.53% right now, or a money market fund like Vanguard's VMFFX at 3.60%. This is your shock absorber. When the market crashes, and it will, you spend from this bucket. You never touch VOO during a downturn. That's the whole point. Bucket 2 is your income bucket. This holds about 5 to 8 years of spending. You fill it with high-quality bonds and dividend ETFs. SCHD pays a 3.33% yield right now, with a strong track record of growing that dividend every year. On $300,000 in SCHD, that's roughly $10,000 a year flowing to you in dividends without selling a single share. VYM and DGRO are solid choices here too. Bucket 3 is your growth bucket. This is where VOO stays. Long-term growth. You don't touch it for 7 to 10 years. It has time to ride out any crash and recover. 3 numbers to remember. SGOV at 3.53%, SCHD at 3.33%, VOO at 1.05%. 3 buckets, 3 jobs. Cash protects you, dividends pay you, growth compounds for you. Now, I want to be honest about something. Michael Kites, one of the sharpest financial planners in the country, ran the math on bucket strategies back in 2014. What he found is that buckets don't actually beat a simple rebalanced portfolio. The long-term returns are mathematically identical. So why use buckets? Because in March 2020, when the market dropped 34% in a month, knowing you had 2 years of cash in bucket 1 is what kept you from panic selling VOO at the bottom. The bucket strategy isn't a math trick, it's a behavior trick, and over 30 years of retirement, behavior is everything. Now, pair this with a flexible withdrawal rule. Morningstar's latest research says the safe starting withdrawal rate on a fixed plan is 3.9%. But if you use guardrails, cut spending by 10% when the portfolio drops hard, raise it by 10% when it grows, that starting rate jumps above 5%. On a $1 million portfolio, that's the difference between $39,000 a year and $50,000 a year, just by being flexible. So now you have the fix, but there's one last number you need to know, and it tells you whether your current setup is safe or not. The one number to tell you if you're safe. There's a measure called the CAPE ratio. It tells you how expensive the stock market is compared to its long-term earnings. Right now, it sits around 41. That's the second highest reading in 140 years of American market history. The only time it was higher? December 1999, right before the dot-com crash. And we already talked about what happened to retirees who were 100% in the index when that bubble burst. Bill Bengen, the man who invented the 4% rule, updated his research in August 2025. At today's valuations, his safe starting withdrawal rate on a diversified portfolio is 4.7%, not on a 100% VOO portfolio, on a diversified mix of stocks, including small caps, mid caps, and international. Morningstar says 3.9% on a fixed plan, with guardrails over 5%. If you're pulling more than 4% from an all VOO portfolio with no cash bucket and no dividend sleeve, you're flying without a safety net in the most expensive market in a generation. The fix isn't complicated. 3 buckets, 1 afternoon to set up, and the discipline to leave VOO alone when the rest of the world panics. VOO builds the wealth, but it was never designed to pay the bills. If someone you know is retired with most of their money in VOO, send them this video right now. It could save them from a mistake they don't even know they're making. What's your current split? Are you all in on VOO, or have you already started blending in dividend ETFs? Tell me in the comments. If you're building retirement income and want to stay ahead of moves like this, subscribe to Dividend Hustle. I cover everything that protects your paycheck in retirement. And next up, I'm breaking down the exact 3-bucket withdrawal system step by step, the specific dollar amounts, the specific ETFs, and exactly how to set it up at every stage. You don't want to miss that one. Keep building toward your great, big, beautiful tomorrow.